the value of the car you want to drive is determined by those who actually own bonds. And that is why if you don't understand bonds, you truly don't really understand how money works, because bonds are the foundation of how money actually works, in the sense that if we are to define bonds in a very simple term, we can say that every bond is a promise to pay money in the future. And those promises create the framework for interest rates, which is simply the price of money over time. The returns an investor gets for holding bonds is known as yield. And when bond yields rise, borrowing becomes expensive. When they fall, money becomes very cheap. That one mechanism shapes everything from mortgage rates, student loans, the value of that car you want to drive, the value of the stock market, to the extent that central banks literally create and destroy money by buying and selling government bonds. So, when you understand bonds, you don't just understand another type of investment instrument. You actually understand how the entire financial system works. In this video, we are simply going to learn about bonds in very simple terms from an investment instrument point of view, and then subsequently understand how bonds control the entire financial system. My name is Paddy. Don't forget to support the channel by subscribing, liking this video, and sharing it to a friend to also get the same value you are about to get. Now, let's go to the board. So the first thing I want you to understand when it comes to bond is that anytime you hear of bonds, right, know that we are talking about debt, right? That is the first idea that I want you to keep in mind. So let me put that somewhere here. Bond is equal to debt. Okay. And we are going to get it from this angle. When a company is set up, let's name our company LIFO Limited, a company that we just set up. There's no doubt that a company needs capital to operate. There is a capital requirement, all right? And this capital could be raised in two ways. One, by way of equity, and also by raising debt. Equity is simply the money or the capital that is provided by the founders of the company. And the founders can also decide to raise equity by selling bits of the company by way of shares to the general public. So if the founders provide money or they try to sell shares or bits of the company, that part of the capital structure is known as equity. And I would want you to understand the earning profile, how these people earn money by way of providing equity. So the earning profile of these equity providers is that these people make money through share valuation, which simply means that if one share of the company is $10 and the share goes up to $15, they are able to sell the shares and make a profit of $5, as simple as that. Or they can make money by what is known as dividends. Now, dividends is when the company makes money through its normal operations. The company makes profit and the company decides to use a bit of the profit to compensate these people. And the point here is that the most important part, what I want you to understand here is that dividends is not guaranteed, all right? If you are an equity provider, it is not a matter of fact that you should be compensated through dividend. So you could be part of a company infrequently, you are not entitled to it. Now, we said debt is another way to raise money, and we have already identified here that bond is equal to debt. And the purpose of this video is to help you understand bonds, meaning most of our concentration is going to be at the debt part of the capital structure. All right, so let's use a very simple example. We have already incorporated our business, okay, which is LIFO Limited. Let's assume that LIFO Limited need a capital requirement of $5,000 to operate. All right, the first way to raise the money is through equity. The founders of the company have been able to provide $4,000. We are left with $10,000. So they decide to borrow money, okay, to go for debt, all right, to go for the remaining $1,000. Now, what these people want to do is that they want to approach you, an individual investor, for you to give them this money. So you give the company the $1,000. The question here is that what is your relationship with the company by way of this $1,000 that you have given them? Okay, because you are not part of the founders, which means you are not a shareholder, and you don't want to be a shareholder. So we have to identify your relationship with the company. And your relationship with the company is purely legal. There is a legal contract, agreement, which stipulates or which captures the fact that you have given this company $1,000. All right. So we are talking about bonds here. Now, this legal contract is captured in a document known as the indenture. And it is this indenture that the company is making several promises to you. Several promises. We are still establishing your relationship with the company. So the company is promising you certain things like an interest. So the company tells you that, oh, you know what, we are going to pay you, for example, 7% every year for this money that we've taken from you. The indenture also stipulates the duration for this contract. So the company is going to hold on to this money for 5 years. Now, there are many other things that this indenture captures, and it is very important for us to understand this. Among other things, it is telling you what is known as the par value. So par or face value. And this is very important for you to understand. Let's make this $1,000. This par value or face value is how much the company is promising to pay back at the end of the bond contract or the debt agreement. Let's let this line represent our bond agreement, okay, to stipulate all the terms that we have captured here so far for 5 years, right? So this is year 1, year 2, year 3, 4, and 5. This is the start, year 0. This is the start of the agreement. Because this is a debt, we have already established that this is debt. This is debt. It means that when you buy a bond, you as the debt provider, you expect to be paid back at the end of the 5 years. And the indenture acknowledges this. So the company is saying that at the end of the 5 years, we are willing to pay back $1,000. So this is the par value. It is already stated at the start of the contract, even before you buy it. So the moment you pick up the agreement, the moment you pick up the indenture, you see this on the face of it, that this is how much we are willing to pay people who give us money or who are purchasing this bond at the end of the contract. So what this one is doing is that at the start of it, it is determining the value of the bond. If the provider, the debt issuer, or the company is going to give you $1,000 at the end of the contract, what it simply means is that you should also equally just give it $1,000, because that is what you are going to be giving back. So you are giving them $1,000 at the start of it, then you are going to be getting your benefit. Year 1, you are getting 7%. Year 2, 7. Year 3, you have your 7, you have your 7 here. And at the end of year 5, not only are you getting your 7%, because this is the last year, you will get your 7% plus the $1,000, the principal that you gave them, all right? Or the $1,000 that the company, the par value that the company has promised. So this $1,000 plus your 7%, okay? Or let's say, which is going to be $70, right? So what I want you to understand here is that these ones are known as coupon. Okay, we have to use the right word. So these ones are a coupon payment, which also means that the right term for this is what? The coupon rate. So the coupon rate is how much interest that the bond is giving you. What I also want to state here is that these ones are predetermined. It is a debt obligation that the company has assumed to do. You are going to get all these ones you are definitely going to get these ones. And that is why a lot of people buy bonds during retirement, because it is going to provide a steady or reliable source of income. The benefits under this one are determined. They are fixed. And the reason why you would hear that a bond is known as a fixed income security. So you remember the earning profile of the equity provided. We said that they either get dividends or they make money through share valuation. And we said that dividends are not guaranteed. All right. So unlike the equity providers, the bond holders of a company, they have a fixed income. There is also one thing that I want you to understand here. We said that this par value is determining the value of the bond at the start of it. So this is how much you are going to buy that bond in the market. So the market price is determined by what? The par value at the start of it. But there are times that you get into the market and this bond is not trading at 1,000. There are times that you get into the market and this bond would be $800. Other times it's going to be somewhere, let's say, $1,200. All right. The fact that you are buying it cheaper, or you are paying $800 here, does not affect the par value. This par value has already been stated and it's fixed. The fact that you are buying it for $1,200 does not change the par value. The par value doesn't change. So if you got a bond at $1,200, that is where we say you are buying the bond at a premium. So this becomes a premium bond. Why? Because you are paying a premium of $200. You are paying more for something that is going to give you $1,000 at the end of it. It doesn't change. And if you got this at $800, then now the bond is a discounted bond, meaning you are paying less for something that is going to give you $1,000. That's going to give you more at the end of the contract. And the reason why people may want to buy or pay more for a bond of $1,000 or pay less for a bond of $1,000, we are going to explain everything in detail in the subsequent sections. All right. So when you pay $1,000 and you receive $1,000, that's where we say the bond is at par. All right. So this is the basic understanding of bonds. If it is a bit confusing, you can just rewind it. You can go back a bit and try to understand it better before moving forward. So now let's look at the other sections and put all the pieces together. Let's look at what I consider the key features due diligence, what you have to look out for. We are going to limit them to just 4. We want to talk about the issuer. We are going to talk about the credit risk or ratings, the issuer. We would want to understand maturity of the bond. Then we would want to know whether we are paying a fair price or fair value for the bond that we are buying, because that is also important. So we would really want to understand the market price of the bond versus the par value. Let's take this one after the other. This is the first key feature that we want to understand. The first thing we really want to understand is who is issuing the bond. All right. So the issuer of the bond is the borrower, the person who is borrowing money from you. All right. And we really want to understand the borrower or the issuer because it is our first easy way to assess risk. Because for instance, we have different types of borrowers. The first one, let's talk about the supranational institutions. So over here, we are talking about issuers or borrowers like the World Bank or the IMF. I like to make the argument that we live in a world of possibilities, all right. But when it comes to lending money to the World Bank or the IMF, I mean, what are the chances that they are going to default on paying you the promised coupons or not even paying you the principal at the end of the contract? The chances are very slim. So there is almost 100% certainty if you should lend your money to these people. All right. So these guys are considered some of the safest issuers or borrowers in the market. So that's why I'm saying that knowing who the issuer is an easy way to assess risk. All right. So the first people are the supranational institutions. The second one, we can talk about sovereign governments. So here we are simply talking about governments of sovereign countries. So of course, we are going to talk about the USA government or the federal government of the US. We can look at other governments like the UK. Let's talk about Germany, for instance. All right. Now, to be specific to the issue of bonds, the US has got what is known as the US Treasury. That is the bond of the US. The UK has got what is known as the UK gilts. Germany has got the bonds for short. Okay, bonds issued by the US government, as we call it, is dominated in dollars. The same way the UK bonds are dominated in the Great British pounds. Bonds from Germany are in euros. Now, these guys are also considered very safe, if not some of the safest. And their safety is premised on the fact that as a sovereign government, they are in control of the monetary policy of the country or of their respective countries. Okay, so in the worst case scenario, if you bought a US bond, in the worst case scenario, all right, or if the US government is struggling to pay you to meet its debt obligation, it can simply print so much dollars. The UK government can equally print so much pounds to pay you to meet their debt obligation. So lending your money to these guys is also very safe because they are in control of their country's monetary policies. All right, so these are other types, another type of the issuers on the market. We can also look at what is known as the sovereign entities. So these are not the governments themselves, but these are, for example, the local authorities in the country. Like, for instance, in London, in the UK, in London, we can have the London City Council, right? It's just an example of a sub-sovereign. All right, so they have got some good level of local governance or governance in the country, but these guys are not in charge of the monetary policy in the country. So in the worst case scenario, they may probably need assistance from the government itself to meet their debt obligation. All right. So in as much as, they are safe, they are all right, their safety level is okay. Comparing them to the government itself, the government has got a high level of safety or security when it comes to meeting debt obligations. Then we can also we can come down a bit to talk about quasi agencies. So these are agencies within the country or within the city. For example, in the US has Ginnie Mae. They have Ginnie Mae, hope the spelling is correct, and an agency like Freddie Mac. So these are independent entities, but they are backed, or they have the backing of the government. When they are issuing bonds, you should be able to assess their risk factor from the fact that though they are backed by the government, they are semi-independent. And the last one we are going to look at, which is also very important, is corporations or the corporate entities. Here we are talking about, let's use some of the big boys in the game. Amazon, the companies, right? Talking about Apple, let's talk about Microsoft. All right, we currently live in a world where some of these companies are more wealthy than some countries. Let's talk about Nvidia, for instance. Nvidia is, I think, the richest company, and its market cap is bigger than the GDPs of a lot of countries. What people don't know is that the balance sheet of these companies has a lot of debt. These guys issue loads of debt because their capital requirement is a lot. They need a lot of money to operate. So aside the equity of the companies, they issue loads of bonds to operate. And one thing, when you are purchasing bonds from corporations, why it is important to know your issuer is that bonds coming from these people have got the highest form of risk as compared to the government, okay? Because we say the government can easily print money. What about these guys? So they have got the highest level of risk when you have to do the comparison between the government and these guys, because these guys are private entities. We like to say that these companies are public companies, but when we talk about them as public companies, we are not referring to them as, being part of the public or the government. They have no relation with the government. We only say they are public companies because they are listed on the stock exchange or the stock exchanges. And that simply means that they have invited the general public to be part of the ownership of the company. They are listed on the stock exchange, so you can easily just go here and buy shares and be part of the company. In other words, they have invited the general public to be part of the company, as compared to a company which has not gone through the IPO process, which is not inviting the general public to be part of it. So now, for instance, when we talk talk about ChatGPT or OpenAI, you can't go to the market and want to buy shares of OpenAI because OpenAI is a private company, whereas you can go to the market and buy shares of Amazon because Amazon is a public company. So this is the difference when we say one is public and one is company. But it is not because Amazon has a state backing or is part of the government. So these guys, when they borrow money from you, because they are private entities, they only have a limited way by which they can pay you. They can pay you from the operations of the company, all right? The fundamentals. When the company performs well, of course, they are going to make money. They are going to use part of their profits to pay you to meet their debt obligation. They can also do what is known as debt refinance. Debt refinance is when they are borrowing more money to pay the debt that is due on their books. So they are refinancing the debt. Another way, in the worst case scenario, is to liquidate the company. That is, they are selling the assets of the company to pay you. All right. And like we said earlier, in that case, you, the debt provider, are going to be paid first before the shareholders. So they only have a limited way by which they can pay you. All right. So that is why we are saying that they have the highest level of risk. I mean, you understand why this is a key feature. It is very important to understand your issuer because understanding who the issuer is the first layer to assessing the risk of the bond. The next key feature is to understand the credit risk of the issuer or the ratings. Now, I would like to make the argument here that knowing who the issuer is different from understanding who the issuer is. So here we really want to understand their credit risk because it is very important. Like we said, a bond is debt. At the end of the day, we want to make money. All right. So we really want to understand that this bond issuer can pay us our profits, which is the coupon that they have promised to pay us, which is the 7% that they have promised to pay us. But more importantly, we really want to know that this guy can pay us back our principal at the end of the contract. All right, because, well, even if you are not able to pay us this one, we surely need our money back. So we want our profit plus, more importantly, we want our principal. So we know the issuer all right, but we really want to understand the credit risk, the credit history, the ratings of these guys before we go ahead and give them our money. All right, so let's look at two categories here. Let's call this category A, and let's put a country like the US in this category. All right, category A. Now, for top sovereigns like the US, the risk is considered virtually zero. Okay, because the US government controls its own currency, like you said, and it can always create dollars to pay you. So as a matter of fact, the US Treasury bond, which we introduced earlier, so the short-term Treasury bond has become what is known as the global benchmark for what is known as the risk-free. Okay, now let's talk about the risk-free rate. It simply means that it is the rate or profit that you are setting to gain, a type of investment that you are making where you are virtually assuming zero risk. All right, so what it means is that if you buy the US Treasury bond, you are almost 100% sure that you are going to get your profit and you are going to get your principal. So we can say that the Treasury bond or the US Treasury is a non-defaultable bond. I don't know if that's the right word or there's a term like that. It has never defaulted. When you give your money to the US government, you are almost 100% sure that you are going to get it. So that is the security, how safe it is, to the extent that it has become a global benchmark for what is considered a riskless investment. So what do you think is going to be the rating of such a bond? If there is anything better than a AAA, I think this is what is going to be the rating for this treasury bond. All right. Now, second category, calling it category B. Let's look at a country like Argentina. Argentina has become what is known as a serial defaulter. Okay. It means they are known for defaulting on their debt obligations to the extent that I stand to be corrected, but I think up to date, it has defaulted 9 times on its debt obligations, with the recent one being close to about 70 billion default in the year 2020. All right. So it goes back to the argument that knowing who the issuer is different from truly understanding who the issuer is. Because imagine going for a bond issued by these governments. Okay. And like we said, sovereign governments are some of the safest in the market and immediately you saw the bond from a sovereign government, you thought, oh, this bond is coming from a safe or one of the safest issuers in the market, you would have made a very big mistake. Definitely giving your money to a country that is known as a serial defaulter, and you are definitely assuming a very high risk. The probability that you are not going to get your profit and even your principal is very high, right? So I hope understanding the credit risk and rating is very I hope the explanation on this one is clear enough. And there's a very simple way for you to know the credit risk or rating of the bond issuers. You can simply use what is known as the credit rating agencies to help make your work easier, like Moody's. Okay, we have the S&P, and we have another rating agency, Fitch. All right, these guys have all got different scales of rating, but I mean the scales are quite the same. All right, so with very good bonds, they are normally going to get ratings like AAA, all right, AA. They can have BBB, all right. And with the very bad bonds, I mean, for lack of better expression, we can have ratings like BB, B. We can have CCC, and even something lower. Okay, and based on the scale that they do this rating, bonds are divided into two categories. So bonds under this range are going to be known as the investment grade. These are going to be investment grade bonds, and bonds under this category are going to be high yield bonds, high yield or speculative bonds. The name high yield because these guys are promising very high returns. They are promising very high returns, and they are promising these high returns because equally they have very high. And that's just, I mean, the basic theory in investment. The more risk you assume, the more you expect to be rewarded for assuming that high level of risk. But sometimes, I mean, these high returns, no matter how high they are not worth the risk that you would assume as an investor. All right, these guys, I mean, it goes without saying that these guys are investment grade. I mean, the risk assumed here is quite less, so they are normally providing moderate returns, something not too far from what you would have got from the market. So I hope this part is also very clear. The next important feature, like we said, is maturity. So maturity here, we are talking about the date that the issuer will redeem the bond and pay the outstanding principal amount back to you, the investor. So if we have one bond, let's say bond A, that is for 5 years. All right, it simply means that after 5 years, you are getting your 1,000 back plus your last coupon payment of 7%. Okay, you are getting it. And if bond B is 8 years, then the same thing. At the end of 8 years is when you are getting your principal and your last coupon payment. All right, and this is important, so that you understand what is known as the money market and the capital market. Money market, simply in the case of bond here, is any bond that is less than 1 year. As any bond, so we have what are known as the short-term bonds, very short-term bonds. And the capital market are the bonds that are more than 1 year. So these are long-term bonds. All right. So assuming that a company like Amazon is raising several billions, let's say 10 billion in debt. All right. Of course, this is a lot of money, and they need it for what? For a capital infrastructure or capital expenditure. Okay, so normally these bonds are long bonds. They are long term, about 10 years, 20 years, some could even be 30 years. And you have to know this because it helps you to determine whether you are ready to part with your money for this long, whether you have got the ability to part with your money for this long. So it helps you to plan, to know your investment plan. Now you can go for something that's very short term, or depending on your investment strategy and exactly what you are looking for in investing in bonds. So this is very simple, but it's also very important to help you to know how to make some of your investment decisions. So now we are on to the next key feature, which is very important. So here we are trying to know if we are paying a fair price for our bond. So we want to make a distinction between the market price and the par value. All right. So let's try to understand this from the angle of buying shares rather than bonds, okay? Because it is the same underlying understanding. Assuming that you woke up one day, you just want to buy 20 shares of Amazon. These days, it's very easy to do this. What you normally do is simply take your phone and open a mobile app, place your order, all right, for 20 shares, and that is it. You are done. You have your shares. But what you have to understand is that the day that you are buying these 20 shares, it's not the first time that Amazon is trading its shares on the market. The first time that Amazon traded its share on the market was during what is known as the IPO, which is the initial public offering. All right. So the initial public offering here is what is known as the primary market. It is the primary market because it is the first time that they went to the market to trade their shares, and probably you were not even born during this time, so you couldn't partake in this. So what it means is that only a few people, only a few players, normally the big boys, who got a chance to buy the shares. So assuming that Amazon was raising 10 billion when it offered the shares, it got the money that it needed. All these guys were able to buy the shares, to raise that money, to give that money to Amazon. What you have to understand here is that these guys are also investors, all right? So after buying these shares, they also need a market to trade, to make their money, to make their profits, okay? So they need a platform, they need another avenue for them to trade. And that introduces us to what? Here, this one, which is the secondary market, all right? So this mobile app that you open is taking you to the stock exchanges, which is what? The secondary market. So the first time you bought your 20 shares, you are not even dealing with Amazon. You're rather dealing with investors, other traders, okay? So in the secondary market, what is happening is what? Trading, buying and selling. People offloading their shares and other people buying it, all right? So a lot of activities are happening here, okay? So there's a lot of buying and selling going on in the secondary market. If there is so much demand on this share here, on this Amazon shares here, what it means is that the value of the shares are going to go up. So if they were trading, let's say for $200, so much demand is going to make it about, let's say, 210. So in the secondary market is what determines what is known as price discovery. So either the price, the share value is going to go up or it's going to go down. Here, a lot of economic activities or economic factors are happening here to determine the price discovery, the value of the shares. And it is the same ideology with bonds. All right, we are still on the way to understand our premium bonds. The first time that the new issuance is done in the primary market, it's only a few people who get access to buy it. So we are talking about hedge funds. We're talking about insurance companies and the big banks that are able to raise the debt that the government wants, okay? After that, these guys also need a secondary market to sell these bonds that they bought. So the first time you want to buy a bond, remember our bond A from LIFO, you are likely dealing in the secondary market, which means that if there is so much demand on the bond, the price of the bond is going to go up. And if there is little demand or very low demand, the price is going to fall. And that is why that a bond that started at the par value of 1,000 could come to what? Could still either be at 1,000, it could be 800, or it could be at 1,200. So if at the time that you got access to the bond, price discovery has made the price gone up to 1,200, then you are paying a premium of 200 for the bond. You are paying $200 more than the price that the bond started, and that is how you get premium bond. If at the time you got a bond, the price is 800, then it means that price discovery had made the price gone down in the secondary market. All right. So now you are buying the bond at a low price. So you are buying the bond at a discount. And remember, no matter how much you got a bond at the market, the par value doesn't change. The par value has been set right at the beginning by the government or by the company that issued the bond. Okay. Now, I know that a question you could be asking is that why would I buy a bond for 1,200 if at the end of the day, or at the end of the contract, all I'm going to get is 1,000 back? So let's use a practical example to understand this. So let's look at why you would still want to buy a premium bond. So imagine that you have $1,000 to invest. You have $1,000. You've received your paycheck. You want to start investing. Okay. and you have two options. The first option is just to deposit your money at the bank and receive an interest of, let's say, 4% on your money for a period of 5 years. The second option is to buy a bond, okay? Is to purchase our bond A. Remember, our bond, the coupon rate, like we said, was 7%, also for the period of 5 years. Let's look at why you may want to purchase a bond if it is premium. You want to make a smart investment, just like everyone else. So you are likely not going to choose this, because why should you deposit your money at the bank, which is paying you just 4%, when there is a better investing option? This is going to give you 7%, all for the same duration, okay? So let's look at this. Assuming you give your money to the bank, $1,000 times the coupon, the interest rate, which is 4%, right? For a period of 5 years, because this is a yearly interest rate. We are going to get, this is going to give you 40, right? So we are going to make $200 in terms of interest. So this is bank, just not to confuse ourselves, right? The second option, bond, the same 1,000. The coupon rate is 7 for the same duration. This is going to get you 70. So this is going to get you 350. This is a better investing opportunity. Almost everyone who wants to maximize returns on their investment is going to reject investing here. They are going to invest here. So the demand and supply here is going to mean that so many people are going to choose this. Remember, in the secondary market, and once demand is so much for this, then the original price of this bond is going to go up to, let's say, 1,100 instead of the 1,000. So the price going up has not got anything to do with the par value. The par value has already been set. The government or the company has already told you at the end of the contract, they are going to give you 1,000. So remember, our bond at the end of the 5 years, it is still the 1,000 that we are going to receive. Now, the price has gone up to 1,100 in the market, all right? You're making all your coupon investment. You are getting all your coupon. So what it means is, at the end of the day, you are going to make 350 here. So know that we paid a premium of $100 here. We paid more. So even minus the 100 that we paid extra, we are still making what? 250. We are still making $50 more than if we had given our money to the bank. All right. And depending on the multiplier, how many bonds that you are holding, assuming you are holding 100 bonds times this 50, is a lot of money. So this is your motivation for still going for a bond that is trading at a premium. All right. So we can say that a premium bond happens when the coupon rate, which is the rate that the bond is giving you, the coupon rate is greater than what? The market interest rate, or the prevailing interest rate. All right. So if the bond has got a coupon rate here, 7%, which is very good, and the prevailing market rate or interest rate is 4%, everyone is going to go here. Demand is going to set in. The bond prices will go up, and that is how come we get our bonds at premium. Okay, so I hope this explanation is clear. Now let's look at what happens for the bond to be trading at a discount. We are going to use the same example. We have our 1,000 here to invest. We have the same options, either to give our money to the bank or to buy a bond. At this time, let's assume the bank is giving us the same 4% for a period of 5 years. That's what we used in the previous example. But this time around, this bond is giving us 3% for 5 years. I mean, it's very logical that no one would want to buy this bond, right? Because why should I buy a bond for 3 years and assume all this risk of probably not even getting my principal back and all that for a period of 5 years, while I can just deposit my $1,000 in the bank, just deposit this money and get a better rate, a better interest rate for 5 years. So what it means is that demand is going to be too low. Demand is going to fall over here. And if demand falls, well, the price of this bond, which is starting at 1,000, let's say is going to go down to 800. Okay. So because this bond is going down at 800, is going down to 200, that is the first motivation to say that, well, the par value is not going to change anyway. At the end of it, I'm going to get 1,000. The government is going to pay me 1,000 at the end of the 5 years. Year 1, 2, 3, 4, 5. The interest rate, well, it's not really encouraging. You're just going to be making 3. It's not encouraging. But, well, I'm paying a discount. I'm only paying 800 for this bond here. And at the end of the day, I'm gonna make 1,000. So you would realize that at the end of your period, you receive this 1,000 minus because you paid a discount for it. So you are already booking a profit of 200 just based on the price differences. All right. So let's look at how much you are going to make in coupon. So the coupon here is that you are making is 30. Okay, you are making 30 here, 30 for $30 for 5 years. So you are going to make $150. All right, for the period of 5 years. Now, if you just compare the coupon payments and how much you would have made under the bank, we already did for the bank. So the bank would have given you 40 by 5 years. So the bank would have given you 200. All right. So if we compared just the coupon payment and the interest rate, it would have been better to go with the bank or to have given your money to the bank. But because you're already clocking, you're already booking $200 interest profit here, it's going to be your 200 plus the 150. At the end of the day, you're making 350, which of course is way better than the 200 that you would have made under the bank investments. So this is your motivation to buy a bond that is trading at a discount. You're already making profit in the price differences before your coupon payments. Because remember, at the end of the contract, we said you are going to get a par value paid back to you. All right. So I hope the explanation is very simple for discounted rate as well. So this is discounted bond. This is how it works. So we have looked at the premium. We have looked at the discounted. And now when the bond is trading at par, it simply means that there hasn't been a lot of price discovery. Okay. So you are getting the bond exactly at the par value, how much the government has promised to pay you. So here you are paying 1,000. At the end of the 5 years, you are still getting your 1,000. So there hasn't been any match. So this brings us to the end of our first video on bonds. In our subsequent videos, we are going to go deeper and understand it. All right. So this brings us to the end of our first video on bonds. All right. If there is any question that you have, you can please leave it in the comment section, and I'm going to get back to you as soon as possible. We appreciate you still being here. Thank you. And please don't forget to support our channel by subscribing, like it for us. And you can also share so that other people get the same value as you have got here. My name is Paddy. Thank you. And I'll see you in our next video.